Hey everyone, welcome back to Mono Invest, the channel where we break down the world's greatest finance and investing books into practical, real-world lessons that you can actually use in your everyday life. I am so glad you are here today because we are diving into one of the most powerful, most practical, and most inspiring investing books ever written, One Up on Wall Street by the legendary Peter Lynch. And trust me when I say this, by the end of this video, the way you look at everyday life and investing will never be the same again. But before we dive in, I want to quickly tell you about what's coming up next on Mono Invest. Our next book summary is going to be an absolute banger. We are covering The Millionaire Next Door by Thomas J. Stanley and William D. Danko. This book is going to completely shatter everything you think you know about what a millionaire looks like. Spoiler alert, they probably don't look the way you imagine. They don't drive flashy cars, they don't live in mansions, and they don't wear designer clothes. If you want to know the real secrets behind building quiet, powerful, generational wealth, you absolutely cannot miss that video. So here's what I need from you right now. Hit that subscribe button so you never miss a single book summary on this channel. Tap the like button if you love getting financial knowledge that actually makes a difference in your life. And drop a comment below. I want to know, have you ever spotted a great company or product in your everyday life and thought, I should invest in that? Tell me in the comments. I read every single one. All right, now let's get into it. One Up on Wall Street, Peter Lynch, and how this book can literally solve some of the most common financial problems regular people face every single day. Before we dive into the actual lessons from the book, let's take a moment to understand who Peter Lynch is, because his credentials are absolutely insane. Peter Lynch managed the Fidelity Magellan Fund from 1977 to 1990. That's 13 years. During that time, he achieved an average annual return of 29.2%. To put that into perspective, if you had invested just $10,000 with Peter Lynch when he started managing that fund, by the time he retired, you would have had over $300,000. He turned the Magellan Fund from an $18 million fund to a $14 billion fund. He became one of the most successful mutual fund managers in the history of Wall Street. And the beautiful, humbling thing about Peter Lynch? He didn't keep his secrets locked away in some exclusive Wall Street club. He wrote this book, One Up on Wall Street, specifically for regular, everyday people. He wanted normal investors, people like you and me, to understand that we actually have an advantage over the so-called professionals on Wall Street. That is the heart of this book. That is the message he wants you to take home. And today, we are going to explore exactly how that message can solve the real financial problems you face in your everyday life. Let me ask you something. Have you ever felt completely overwhelmed trying to figure out which stocks to invest in? You open your phone, you see thousands of stocks, you hear conflicting opinions from financial news shows, and you just freeze. You don't know where to start. You feel like this is a game only Wall Street insiders can win. This is one of the most common problems everyday investors face, and Peter Lynch has a devastatingly simple answer. He says, look around you. The best investment ideas are hiding in plain sight, right in your everyday life. Lynch calls this the concept of invest in what you know. He argues that before a company gets discovered by Wall Street analysts and institutional investors, regular people, consumers, have already noticed how great the product is. They're already buying it, talking about it, recommending it to their friends and family, and that is your edge. Lynch himself tells a story about his wife coming home from a trip to the mall and telling him how incredible the Dunkin' Donuts coffee was. She went back multiple times just for the coffee. Lynch paid attention to that consumer enthusiasm, did his research, and Dunkin' Donuts turned out to be one of his great winning investments. Think about that. A great stock tip, not from a Wall Street analyst, not from a financial news channel, but from a trip to the mall for a cup of coffee. Start paying attention to your own consumer habits. When you find yourself going back to the same store again and again, when you find a product you simply can't stop using, When your friends and family all start talking about the same brand, those are your investment clues. The next time you walk into a store and notice it's packed every single time, the next time you use an app and think this is going to be absolutely everywhere soon, the next time a friend tells you about a restaurant chain that's expanding into your city, write it down. Then go do your homework on that company. Lynch isn't saying buy stock in every company you like the product. He's saying use your real-world observations as a starting point for your investment research. Your everyday life is a goldmine of investment leads, if you know how to look. This solves the real problem of I don't know where to start. You start where you are. You start with what you know. Let's talk about fear, because fear is the #1 reason most people never invest in the stock market at all, or if they do invest, they panic and sell at exactly the wrong moment. The fear of losing money is real. People work incredibly hard for their income. The idea of watching your hard-earned savings disappear in a market crash is genuinely terrifying. And this fear causes people to keep their money sitting in low-interest savings accounts, earning almost nothing, while inflation slowly eats away at their purchasing power. Peter Lynch addresses this fear directly and powerfully in One Up on Wall Street. Lynch says the stock market is not as risky as people believe it is if you invest with knowledge, patience, and a long-term perspective. The real risk is not investing at all. One of the brilliant and practical tools Lynch gives investors in this book is his system for categorizing stocks into 6 groups. Understanding what type of company you're investing in dramatically reduces your fear because you know exactly what to expect from your investment. Let me break these down for you. Number 1, slow growers. These are large, established companies that grow slowly but steadily. Think utility companies. They won't make you rich overnight, but they are incredibly stable. If you're a risk-averse investor, these are your comfort zone. Number 2, stalwarts. These are big companies that grow a little faster. Think major food companies or household name brands. They're not going to double your money in a year, but in a market downturn, they tend to hold their value better than smaller companies. Lynch suggests these as a defensive cushion in your portfolio. Number 3, fast growers. These are smaller, aggressive companies growing at 25 to 20% per year. These are where the big returns come from. But they also come with more risk. Lynch says the key is to find good fast growers, companies with a strong balance sheet, a replicable business model, and lots of room to expand. This is where Lynch found his 10 baggers. Number 4, cyclicals. These are companies whose fortunes rise and fall with the economy. Think airlines, car manufacturers, steel companies. Timing matters enormously with cyclicals. Buying at the wrong point in the cycle can lead to big losses. Number 5, turnarounds. These are companies that have hit hard times but have a realistic plan for recovery. If you get the right turnaround at the right price, it can be extraordinary. But do your homework, because not every struggling company recovers. Number 6, asset plays. These are companies sitting on assets, real estate, cash, patents, that the market hasn't fully recognized yet. Finding these hidden assets is the treasure hunt of investing. When you understand which category a stock falls into, you stop being afraid of vague, undefined risk, and you start managing specific, understandable risk. You know what you own. You know what to expect, and that knowledge replaces fear with confidence. Lynch also makes a critical point about market downturns. He says that market crashes are not disasters for the prepared investor. They are opportunities. When the whole market drops, great companies go on sale. The fear that makes other people sell is what creates the buying opportunity for you. He says more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. In other words, the people who try to time the market and avoid drops actually lose more than the people who stay invested through the dips. The solution to fear is not to avoid the market, it's to understand what you own and hold it with patience. That is Peter Lynch's answer to one of the most paralyzing financial problems people face every day. Here's one of the most damaging myths in personal finance: the belief that professional fund managers and Wall Street analysts are so smart, so resourced, and so connected that regular investors can never compete with them. This myth keeps millions of people from even trying to invest on their own. They think, who am I to pick stocks? The professionals have computers, research teams, years of training. I don't have a chance. Peter Lynch doesn't just disagree with this, he turns it completely upside down. He argues that the individual investor actually has a structural advantage over institutional investors. And this is not a motivational pep talk. It's a logical argument rooted in how the investment industry actually works. Here's the reality that Lynch lays out. Professional fund managers are managing enormous amounts of money, billions of dollars. That means they can only invest in very large companies. A tiny company that could triple in value is completely invisible to a fund manager because the position would be too small to matter to their portfolio. But you can invest in that tiny company. You can buy $1,000 of a small, fast-growing company that a Wall Street fund can't even touch. And if it grows 10 times, you've just made a $10,000 profit on a $1,000 investment. That is the power of being a small investor. Additionally, professional fund managers are under enormous pressure to produce short-term results. If they underperform for even one quarter, they face scrutiny from their clients, their superiors, and the financial press. This short-term pressure forces them to make decisions that are not in the best long-term interest of the investment. They can't afford to be patient, but you can. Lynch also points out that institutional investors tend to herd. Because fund managers are judged against each other, they tend to gravitate toward the same popular stocks. Nobody gets fired for owning IBM, even if IBM is overpriced. But a fund manager who bets on a small, unknown company and is wrong will face serious consequences. This institutional fear creates an enormous opportunity for the individual investor who is willing to do their homework and back their own judgment. And here's the most beautiful part of Lynch's argument. Individual investors live in the real economy. You shop, you eat, you work, you commute, you go to the gym, you use apps. Every single day you are gathering data that Wall Street analysts don't experience firsthand. A Wall Street analyst sitting in a Manhattan business building cannot know what it feels like to walk into a brand new fast food restaurant in a suburban mall and see every single table full at lunchtime. But you can know that, and you can act on it before the analyst writes a report about it. Lynch says the amateur investor has numerous built-in advantages that, if exploited, should result in outperforming the experts and also the market in general. That is an extraordinary statement, and it's backed by his own extraordinary track record. So the next time someone tells you that regular investors can't beat Wall Street, remember Peter Lynch. Remember that your life is research. Remember that your patience is a superpower. Remember that your small size is a structural advantage, not a handicap. All right, let's tackle another enormous barrier to investing: the feeling that researching a stock is just too complicated, too technical, too intimidating for a regular person. People see financial statements with numbers running down pages of tiny text. They hear terms like price-to-earnings ratio, earnings per share, debt-to-equity ratio, and they feel like you need an MBA from Harvard just to understand what you're looking at. Peter Lynch cuts through all of that complexity with refreshing simplicity. He says, you don't need to understand every financial metric to be a great investor, but you do need to understand a few key things about the company you're investing in. Let me give you Lynch's simple research framework. First, can you explain the business in 2 minutes or less? Lynch calls this the 2-minute drill. If you can't clearly explain what a company does, how it makes money, and why it's going to grow, don't invest in it. Simplicity is a sign of clarity. Complexity is a sign of confusion. Second, what is the company's story? Lynch believes every investment has a story, a reason why the stock is going to go up. Is it a fast grower expanding into new markets? Is it a turnaround company with new management and a clear recovery plan? Is it a company sitting on undervalued assets? Know the story before you invest. Third, what is the price-to-earnings ratio? Lynch simplifies the PE ratio brilliantly. He says, a company whose stock is priced at 15 times its annual earnings per share has a PE of 15. If it's growing at 15% per year, that's a fair price. If it's growing at 30% per year, that's a bargain. If it's only growing at 5% per year, that's overpriced. Compare the PE to the growth rate. Lynch calls the relationship between growth rate and PE the PEG ratio, and a PEG of 1 is fair value. Under 1 is potentially undervalued. Fourth, how much debt does the company have? Lynch is a huge fan of companies with strong balance sheets and low debt. A company drowning in debt is vulnerable in a downturn. A company with cash on hand and low debt can survive tough times and even take advantage of them. Check the debt-to-equity ratio. Generally, lower is better. Fifth, is the company buying back its own shares? When a company buys back its own stock, it's essentially saying, we believe our stock is undervalued, and this is the best use of our cash. Buybacks reduce the number of shares outstanding, which increases earnings per share, and that's bullish for the stock price. Sixth, are insiders buying the stock? Lynch pays close attention to whether company executives, CEOs, CFOs, directors, are buying shares in their own company with their personal money. Executives can sell shares for 1,000 different reasons. They might need cash for a vacation home, a divorce, college tuition. But there's only one reason executives buy stock with their own money. They believe the stock is going up. Insider buying is one of the most bullish signals an investor can find. Lynch reminds us that all of this information is publicly available. You can find it in the company's annual report, on financial websites, and in SEC filings. You don't need a Bloomberg terminal. You don't need to pay for expensive research reports. The information is free and accessible to anyone willing to spend a few hours doing their homework. The research doesn't have to be complicated. It just has to be thorough enough for you to understand the story, the numbers, and the risks. That's it. That's Peter Lynch's research framework, and it's entirely within reach of every single person watching this video right now. This one hurts. This is the problem that has cost regular investors more money than almost anything else in investing history. You buy a great stock, the price drops, you panic, you sell. And then you watch it triple over the next 2 years while you're sitting on the sidelines with your measly cash. It's one of the most emotionally painful investing experiences you can have, and it's incredibly common. Peter Lynch addresses this behavior extensively in One Up on Wall Street, and his insights are some of the most psychologically valuable in the entire book. Lynch identifies a critical human tendency. We are wired to want to lock in profits quickly and to avoid the pain of watching a loss get bigger. This wiring made sense in the prehistoric world. Grab the food now before it disappears. Run from the predator immediately. But in investing, this ancient emotional programming is your worst enemy. Lynch describes a phenomenon he calls watering the weeds and pulling the flowers. When investors have a portfolio of stocks, they tend to sell the ones that have gone up because they feel the urge to lock in profits, and hold the ones that have gone down because they don't want to realize a loss. This is exactly backwards from what good investing requires. The winners that have gone up are often continuing to go up. The losers that have gone down often continue to go down. Lynch popularized the term 10-bagger, a stock that grows to 10 times your original investment. And he is very clear about one thing. You cannot catch a 10-bagger if you sell too early. A stock doesn't become a 10-bagger in 6 months. It takes years, sometimes many years, of patient holding through dips and corrections and scary headlines before it delivers that extraordinary return. Lynch held some of his best-performing stocks for years, sometimes through drops of 30 to 50%, because he had done his homework, he understood the company, and he believed in the long-term story. He gives this simple but powerful piece of advice. Before you sell a stock, ask yourself these two questions. 1, has the fundamental story of the company changed? And 2, is the stock still priced reasonably relative to its earnings and growth? If the answer to both questions is the story is still intact and the valuation is still reasonable, then a price drop is not a reason to sell. It might actually be a reason to buy more. Lynch also advises investors to revisit their portfolio's thesis regularly, not to obsess over daily price movements, but to periodically check whether the original reasons you bought the stock still apply. If a company launches a new product that changes the competitive landscape, if management changes and the new leadership seems incompetent, if the company takes on excessive debt, these are reasons to reconsider your position. But a 15% price drop because the overall market is having a bad week, that is almost never a reason to sell a great company. The solution to selling too early is developing the conviction that comes from truly understanding what you own. When you know the company, know the story, and know the numbers, you can hold through the turbulence with confidence instead of panic. That is one of the most valuable lessons Peter Lynch teaches in this entire book. Here's a problem that doesn't get talked about enough in personal finance: over-diversification. Most people think diversification is always good. The more stocks you own, the safer you are, right? Peter Lynch has a very different take, and he even coined a term for excessive diversification: de-worsification. And this concept could save you from the mediocre returns that come from spreading your money too thin. De-worsification happens when you diversify so broadly that your portfolio becomes a mirror image of the overall market, and you're guaranteed to get average returns, not exceptional ones. When you own 50 or 60 stocks, the outperformance of your 3 great picks gets completely diluted by the mediocre performance of your other 47 picks. Lynch's argument is that the average individual investor should own between 5 and 10 stocks they have genuinely researched, genuinely understand, and genuinely believe in. Not 50, not 100. 5 to 10 well-chosen, well-understood companies. He also warns against another form of de-worsification: buying stocks just to diversify into sectors you know nothing about. Owning shares in a pharmaceutical company because you think you should have some healthcare exposure without understanding a single thing about that company's drug pipeline is not diversification, it's gambling with extra steps. Lynch's philosophy is clear: own fewer stocks, but own them well. Know exactly why you own each one. Have a clear thesis for each investment. Update that thesis regularly, and when a stock no longer meets your criteria, sell it and redeploy the capital into something better. He also cautions against owning shares in companies whose products you don't understand or use. If you work in technology and understand software companies, stick to what you know. If you're a nurse and understand medical device companies, use that knowledge. Your professional expertise is an investing edge. Use it. The solution to mediocre returns from over-diversification is not to own more stocks, it's to own better ones. It's to go deep on a smaller number of companies, rather than going shallow on 100 companies you barely understand. That is the Peter Lynch philosophy of portfolio construction. Let's talk about one of the most seductive and most destructive behaviors in investing: trying to time the market. We've all been there. The market is going up, and you think, it can't keep going up much longer. I'll wait for the correction and then buy in. So you wait, and the market keeps going up. Then the correction comes, it drops 10%, and you think, this is just the beginning. It's going to drop much further. So you wait again. Then the market recovers and goes even higher, and you've missed the entire run. Or the flip side, the market is crashing and you think, I need to get out now before it gets worse. So you sell at the bottom and then watch it recover strongly over the next 6 months, and now you've locked in real losses and missed the recovery. Market timing is one of the most studied behaviors in investing, and the research is absolutely clear: it doesn't work. Even professional investors with sophisticated models and enormous resources fail consistently at market timing. Individual investors have essentially no chance of doing it successfully over the long term. Lynch is blunt about this. Stop trying to predict what the market is going to do. Focus on what the individual companies you're invested in are doing. He says that in the 20 years he managed the Magellan Fund, he was asked repeatedly whether there was going to be a bear market soon. His answer was always the same: I don't know, and I don't think anyone else knows either. He didn't try to predict the market. He focused on finding great companies at reasonable prices and holding them. Lynch also makes a deeply important statistical point. The biggest single-day gains in the stock market tend to occur during bear markets, not during bull markets. If you're sitting on the sidelines in cash, waiting for the right time to get back in, you are very likely to miss the single biggest days of market recovery. And missing just a handful of the best days in the market dramatically reduces your long-term returns. His advice is powerful and simple. Time in the market beats timing the market, every time. The investor who stays invested through the ups and downs will almost always outperform the investor who tries to dodge the dips and catch the rallies. So what does this mean for you practically? It means develop an investment plan, invest regularly, whether through dollar-cost averaging into index funds or into individual stocks, and resist the urge to make dramatic changes based on headlines, predictions, or market moods. When the market drops and everyone is panicking, check your portfolio thesis. If the fundamental stories of the companies you own still hang, do nothing, or better yet, buy more at the lower price. This is the discipline that separates great investors from average ones. It's not intelligence, it's not access to exclusive information, it's the emotional discipline to ignore the noise and stay focused on what actually matters, the quality of the businesses you own. All right, let's bring it all home. Here are the 7 real-world lessons from One Up on Wall Street that you can apply starting today. Takeaway number 1. Your daily life is a research lab. Pay attention to the products, stores, and services that excite you as a consumer. These are your best investment leads. Start a list today. Takeaway number 2. Understand the category of what you own. Know whether you're buying a slow grower, a fast grower, a cyclical, or a turnaround, because each category has different expectations and different risks. Takeaway number 3. Do your homework before you invest. Use Lynch's simple framework. Understand the business, know the story, check the PE against the growth rate, look at the debt level, watch for insider buying. Takeaway number 4. Your size is your superpower. As an individual investor, you can invest in small companies that professional fund managers can't even touch. Use that advantage. Takeaway number 5. Hold your winners with patience. Don't sell just because a stock has gone up. Don't sell just because the market has a bad day. Sell when the fundamental story has changed, not before. Takeaway number 6. Own fewer stocks, but own them well. Diversification is real. 5 to 10 well-researched stocks will almost always outperform a 50-stock portfolio where you barely understand what most companies do. Takeaway number 7. Stop trying to time the market and start putting time in the market. Invest regularly, stay patient, and let the power of compounding do its extraordinary work over the years and decades ahead. And that, my friends, is the incredible wisdom packed inside One Up on Wall Street by Peter Lynch. This is a book written by a man who managed billions of dollars and achieved returns that the world's smartest financial minds couldn't match. And his central message was always this: the regular investor, armed with common sense, real-world observations, and a little homework, can absolutely win in the stock market. You don't need to be a Wall Street genius. You don't need an MBA. You don't need a Bloomberg terminal. You need to look at the world around you, understand the businesses you invest in, be patient when others are panicking, and trust the process of long-term compounding. I genuinely hope this video has given you practical tools that you can actually use in your investing life. Not just abstract theory, but real actionable lessons tied to real problems that real investors face every single day. Now here's my ask for you, and it would mean the absolute world to this channel. If this video added value to your life, please give it a like right now. It takes literally 1 second, and it helps this channel reach more people who need this financial knowledge. Tap that like button. Go ahead, do it now. If you are not yet subscribed to Mono Invest, what are you waiting for? Hit that subscribe button and turn on the bell notification so you never miss a single book summary. We are on a mission on this channel to break down the world's greatest finance books into lessons you can actually use, and you do not want to miss a single episode. And please drop a comment below. I read every single comment on this channel. Tell me, which lesson from Peter Lynch hit you the hardest today? Was it the idea of investing in what you know? Was it the concept of diversification? Was it the 10-bagger mindset? Tell me in the comments. Let's build a community of people learning and growing together. And speaking of growing, don't forget, our next video is going to be an absolute game changer. We are covering The Millionaire Next Door by Thomas J. Stanley and William D. Danko, a book that will completely redefine what wealth actually looks like and give you a masterclass in the habits, behaviors, and mindsets of people who have built serious, lasting wealth quietly and without fanfare. If you think being a millionaire means living in a big house, driving a sports car, and wearing a Rolex, this book is absolutely going to blow your mind. The truth about real wealth is far more interesting and far more attainable than most people imagine. So subscribe, hit the bell, and I will see you in the next video. Until then, keep learning, keep investing, and keep building the financial future you deserve. This is Mono Invest. Take care, everyone.